Good afternoon, and thank you for joining the Ellerston Global and Morphic Funds webinar. My name is Lisa Rose, and I'm the Head of Intermediary Sales at Ellerston Capital. Today, we're joined by Bill Pridham, who's the Portfolio Manager for Ellerston and Morphic's Global Equity Strategies. In today's presentation, Bill will provide an update on how a key mega trend is impacting the portfolio, deep dive into a key stock holding, and provide an update on fund positioning and performance for February. I'm sure many of you will have questions for Bill, and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of the screen. I'll now hand over to Bill to start the presentation.
Great, thanks Lisa, and thanks to everyone for taking the time to join me today. Look, I want to take a bit of a different tack this month than we have in the past. There's really no change in terms of my macro view of the higher growth and higher inflation. So I really don't want to rehash that. It's on the past webinar in terms of the drivers there, and it's continuing to come through in terms of those expectations. You know, especially after the 1.9 trillion stimulus package that's about to be approved over in the U.S. and likely another infrastructure package later this year. So I think the higher growth thematic is really coming through, and also the higher inflation on the back of that has to be expected. You know, as supply chains are still pretty tight. Interestingly, I had a call with Tempur Sealy last night, and they put prices up in January in terms of the beds, and they're putting another one up in April. So the one in January was on the back of the previous commodity price increases that they experienced. But given the additional cost increases coming through in terms of commodities, they're putting more price rises through. Two things to take away from that is commodity inflation is feeding through the system. And number two, you want to be in companies that are able to pass that through. So I think we're pretty well positioned from that sense. So with that as a take, and let's talk about a key megatrend, which is really impacting the businesses we have today. It's all around the circular economy. And basically at a top level, circular economy is about, addressing the use of resources globally. And in many ways, when you think about historically, we're hopefully improving, but we've really been a throwaway society. When you think of mobile phones, when you think of appliances, it's to use it once and throw it away, which is really impacting sustainability, landfills, and the like. It's really not sustainable when you think about it. In the World Economic Forum, they kind of highlighted it takes 1.7 Earths today to replenish the resources we're taking out of the system and to absorb the pollution that we're creating as a function of all these goods that we're consuming today. So that really isn't a sustainable, long-term viable option. And I think from a circular economy point of view, we really have to think about how we can address that in a real concerted way. And also in a way that really you think about it from an economic point of view. Corporations still need to make an economic profit, but they also need to consider how they do that with all stakeholders in mind. The take, make, waste business models that are in place today, I think are pretty much destined to be, eroding over time and disintermediated by businesses that are actually moving forward in terms of what they're thinking. Industry 4.0, which is a driver of this circular economy, or a real need to really make the circular economy work. It's been touted as the next industrial revolution. We've had a few industrial revolutions with the steam engines and the printing presses and the like, and clearly the last one was a digital one with the internet and mainframe down to the PC levels. This is the next stage coming through. It's been a while in the making, and I think what's happening now is that you're seeing a lot of technologies converge at once to enable it at the end of the day. You think about 5G. 5G is really starting to be rolled out now from the infrastructure point of view in terms of the networks themselves. Products are being produced which are enabling 5G use, but more importantly, sensors. So sensors have come down a lot in terms of price and gone up in terms of functionality. So really, you have the 5G enabling the connectivity, and you have to connect those physical assets to the digital world, and you need sensors in real time to do that. So you're seeing this come together now in terms of a real driver of this enablement from the circular economy point of view. And when you think about it, companies that don't embrace this, I think will be left behind. In the world of ESG, in the world of consuming at the right level of societal impact, there's a recent survey done by Deloitte where they say 70% of the C-suite executives are saying you really need the enablement of Industry 4.0. You need to put this in practice and in place if you're going to become and maintain yourself in the world going forward in terms of your business at the end of the day. Now, you can do that and be good, but at the end of the day, you're going to make a lot of economic benefits from this as well. There's estimates from the World Economic Forum that there's $4.5 trillion to be taken out of the system and be a benefit to corporations in terms of the bottom lines. And that comes from, lower use of raw materials. It comes from reusing, recycling products at the end of the day, lower carbon footprints, which is a definite cost. So $4.5 trillion of savings to be made over the next several years. And you can do that in a way that really benefits society as well. So it feels like a bit of a win-win from that perspective. But that said, you really do need that Industry 4.0, the connectivity to make all this happen. They say roughly 80% of a product's environmental impact is determined at the design stage. So when a product is being developed and new innovations are coming through, it's really at that stage where you can determine, well, what materials do we want to put in? How can we reuse this at end of life? So it's all about understanding how you can put that together. And still, the product needs to be functional as well. So you need to have all these iterations in place. And it's incredible to think that 80% of that is actually determined at the point of innovation at the end of the day. This is a interesting picture that could have been all of us, in March, April last year in terms of what the COVID-19 impact really could have been. But one thing that is certain, every company says this, is that the digital transformation profile of every enterprise globally has been fast-forwarded by several years with COVID-19. Businesses are doing things much different. They're learning new ways of doing business as well, both from efficiencies and lower cost production. And I think if companies aren't addressing this today, they're really going to be left behind because those businesses that are forward thinking are really embracing it and using it as a way to differentiate themselves going forward. So as the bottom bullet point points out, we view the shift to circular manufacturing, which is effectively enabling the circular economy to be the next big megatrend over the next several years. And I think with that megatrend, it's still fairly early days because let's face it, we've just got the 5G networks in place now. A lot of corporations or big corporations are looking at their local 5G networks to put in place in their own factories. And sensors have come down to a point now where you can actually put them on physical assets and send that information back. But the big thing is, how do you put all that together? And that's one company we have in our portfolio that I think does that in a really strong manner. And that's a company called PTC. So PTC, the power to create is the tagline there. That's not the name of the company. It's the parametric technology company, which is about 3D CAD, or computer-aided design software, which we'll talk about in a bit. So PTC was in our library. We've owned it in the past. And it's one that came down pretty dramatically through the COVID pandemic. So we initiated our position in May. Stock price was a little over $70, and it was just under $9 billion market cap company. Today it's just it's around 16 billion market cap, so it's done quite well for us, but we do consider that there's a fair bit to go in the company in terms of what they're doing and what they're enabling from a long-term perspective, especially when you consider this megatrend really is just starting now in terms of the companies talking about it. So before we get too far down the track, let's take a little bit of a step back and talk about the business itself and a bit of the core part of the business. So computer-aided design. So, what is CAD? So CAD is 2D, 3D pictures. You can see on the left-hand side there of the screen. It's really, designing products, right from tractors to combines to cars to bicycles. And all these engineers are designing these products, and they need this type of software to make it work. Now, the beauty is that it's a bit like Excel. So once your engineers are on these platforms, and there's basically 4 big players in the world. You've got Autodesk, you've got Dassault, you've got Siemens, and PTC. So there's 4 big players in the world. So market share shifts are pretty tectonic. So it takes a fair bit to shift market share because once you're on their platform and are used to designing on their platform, you really don't move at the end of the day. So the real driver for CAD software is innovation, new product development. And I think we're really at the cutting edge of that inflection point now in terms of the need for that, especially as products are getting more complex. And the need for this circular economy really drives the complexity of the design process coming through. So with the CAD software, and PTC is the leader in the 3D space. They've been a leader for quite a while. So you can review, you can simulate. They have a great joint venture or strategic partnership with ANSYS in this in terms of simulation. So you can actually design a product and simulate what it will do in the real world. And that helps you cut down production times. It improves manufacturing efficiencies. And you can actually come up with products that give you a lot more confidence at the end of their life that you can see what they're going to do in the real world environment. So PTC has a business called Creo, and they keep adding new modules to it. So Creo 7.0 is the latest iteration of that, and that's a real driver for the simulation angle going forward. And the Creo 7.0 really is enabling additive manufacturing as well, which is a whole nother layer we can talk through hopefully down the track in terms of what that means from a manufacturing point of view. So the CAD market for PTC is expected to grow high single digit to low double digit for the foreseeable future. So with that type of growth, it's still a very attractive business just as a standalone. The second part of the business I want to talk through is product lifecycle management, which is PLM. So what's PLM? The way I kind of view it is PLM, it basically puts your CAD software on steroids. And it provides a complete view of what that product will do through its whole life cycle. So you can have the CAD specification in terms of what it is designed on the 3D platform. Well, let's see what it's doing as we're manufacturing. Then we can see what's it doing in the field. So you can really see from an iteration point of view what that product is doing. And as it's going through these processes, you can change it, make little changes as you find requirements, in terms of making it better at the end of the day. So what it really is, though, for me, is the foundation of this digital thread. And the digital thread's all about, let's trace this product all the way through. So what is the bill of materials that we're using here? What's our inventory management around this? What's its end life cycle? How can it be reused, recycled at the end? So it's all about that digital thread to see right from start to finish of how this product operates in the field and how we can manage it in the field as well. Because I think what's going to happen going forward from a supply chain point of view, you really need to have traceability. You really need to know what is going into these products, where they're sourced from, and you need data and you need connectivity in real time to make that work. You've heard me talk about this digital twin as well, and this is a real enabler of this. So we'll see later in a presentation, a video of this in real time. But effectively, it's that digital twin. You can see what that product is doing in real time. Hold your iPad up to it and see what those gears or what that product is performing in real time. And it really helps with predictive maintenance. It really helps with less downtime, and it really helps with lower parts in terms of making sure the right part's put in there at the right time, rather than just trying to put any part in just because the product from a lifecycle point of view requires it at that time. It's real-time management of those assets. So PTC has a product called Windchill, which is an open source platform in the market, taking a lot of share. Last quarter grew at mid-teens. Longer term, again, probably in that high single-digit to low double-digit growth in terms of PLM. So as a core business, I just want to take a step back and talk about CAD and PLM because that's the foundation of the group. Now we'll take a little bit of a step forward and let you see that in a little bit real time. It's easier to see it, I think, than hear me talk about it. So hopefully the video will work for you. Hopefully the sound's okay. If not, it'll be in our link. But let's play the video for you just to let you see what it is in real time.
When the world drastically transitions, we're left to navigate a new normal, managing supply chain disruptions and protecting IP while collaborating around the globe. PTC is here to help with web-based tools to digitally transform how you manage your product's lifecycle. From the factory floor to the home office, PTC provides product lifecycle continuity with a scalable, open, and cloud-ready architecture, accelerating how you communicate with secure instant access to contextualized product data. It's ready no matter whether you need to deploy a PTC-managed cloud instance, migrate to the cloud over time, or manage within your own data centers. And with out-of-the-box applications, you can quickly deliver governance, automation, and traceability, whether you're an expert in PLM or not. Collaboration is improved. Quality is built into every product and process, and the modern architecture provides transformative speed, agility, and compliance. When you have the right data at the right time for root cause analysis, action can be taken to increase first-pass yields, reduce scrap and rework, and improve customer satisfaction. With PLM from PTC, you can elevate how product development gets done now.
Great. So I hope that worked at your end. But I think it just gives a good overview of the PLM assets in real time and in real use. And I think the takeaway there's so many different applications for it. You know, you had the snowmobile to the boats and that, but there's just anything that's being produced in terms of products needs to, be developed on a CAD software system. And like I say, PTC is one of the leaders in that space as well. So like I mentioned, CAD and PLM is going to be growing at that high single to low double-digit rate for the next few years. The other side of the business is the real growth arm. If you look at what they've been doing over the last several years, they've been really building this IoT platform, and they are the leader in the space in this. So Gartner to Forrester puts them out in the right-hand top right quadrant in terms of their market share, their NPS scores. So they are definitely the leader in this space. So three key components of Industry 4.0 and PTC is their Onshape business, which they bought a little over a year ago, ThingWorx, which they've owned for quite a while, and they recently bought a business called Arena, which kind of pulls all this together. So the big thing to take away here, those three businesses are really driving the out of market growth for the business and really separating them from the rest of the CAD and PLM software players. So companies, as I mentioned earlier, they're really going through a massive digital transformation stage. Product complexity is increasing. They're shifting to the cloud. We need connected products. If we're going to have a circular economy and make it work, all these products need to talk, and you need to have them all connected. And you think of the billions of products and connections in the market, you need to have a mesh that brings all that together. Effectively, that's what ThingWorx does. Compliance is going up. When you think of regulatory compliance globally, and environmental requirements now, boards are very focused on making sure environmentally they're doing the right thing. And you can only do that when you have traceability at the end of the day. You need to know your bill of materials, where they are, where you source them from, and how they're reused and recycled at the end. In that video you saw, they talked about reducing scrap. That's all about that circular economy nature as well. Global supply chains, when you think about it today, firstly with the U.S.-China trade war, that really started the real focus on supply chains in terms of business continuity and the risk. But COVID-19 just accentuated that. Where's my supply coming from? How secure is it? Can I get it tomorrow? In terms of making sure I've got real-time supply in place. So you really need to have that capability in place. And lastly, accelerating the speed of innovation. If you're standing still, you're going backwards today. At the end of the day, companies really need to be at the forefront of products, especially, but also at the forefront of making sure those products are doing good. And clearly, corporations have stakeholders like us as investors, and we want capital returns. But they also have stakeholders that are focused on making sure from an ESG point of view they're doing the right thing. And we really need this circular economy, and especially 4.0, to enable all that. So just taking another little bit step forward in terms of PTC, in terms of what Industry 4.0 means for them. So freeing desk workers, I know you kind of wonder, what does that mean? So with computer-aided design, CAD software, over 90% of it right now is still on-prem, so still in the offices. So think about COVID-19. What does that mean? So I can't go into the office and work on my desktop with my CAD software. So I really need to have a SaaS delivered or a cloud delivered option for this. And really, there's hardly anybody in the market doing this at scale in a strong and mission critical way. Onshape is that for PTC. So it's basically a pure cloud SaaS delivered product. Interestingly, through the COVID pandemic, one of the big takeaways from Onshape was the ability to develop respirators in real time. And it really kind of highlighted what this Onshape business can do in terms of enabling this. And like we talked about earlier, businesses are going through this digital transformation. You know what? Once you let that genie out of the bottle and you felt and tasted that SaaS delivered model, you want to have that capability in place. And we're seeing that come through now. And the Onshape bookings are up last quarter, they're up 150% on last year. So you're really seeing companies shift themselves towards that. They're not all going to move that way, but you're going to see a lot of movement over time into a cloud-based SaaS model from that perspective. We're going to talk a little bit more about connecting the products and factories, bringing the digital to the front line. So it's all about social distancing. Factory velocity has gone down because, processes have changed a lot within these factories. And I'll show you a couple of pictures in terms of how PTC enables this. But it's interesting, like 75% of workers are front line. So you need to make sure they're enabled. You need to make sure they're able to do their job in a compliant and safe manner as well. And that's where you need this connectivity and the augmented reality component of Industry 4.0, which PTC is the leader in. So let's take a look at a picture here. It kind of puts it a little bit more of a real-time type of, a better way to explain it. So you see a frontline worker here working in an auto plant in an augmented reality manner. So this is enabled by PTC. As I mentioned, they are the leader in the space. So what you can have here now is an industry specialist or a team leader remotely located who can talk this person through this. So they can say, check this dial, check that lever, and do that in real time through an augmented reality aspect. And you can guide them through these tasks. So that industry leader can guide several people, where before they might have been just in that factory and they can only do 2 or 3 at a time. And with social distancing, what does that mean at the end of the day? So now you can do global training, you can do global remote management, and really leverage that industry's knowledge through the base and do this in real time. Again, none of this happens without this 5G interconnection and the sensors in place. So you think about that now. You say, Bill, why didn't this happen years ago? Because it makes perfect sense. Well, it probably wasn't capable in terms of systems. Now it is, and it's, like I said, it's probably in the very early stage of this happening. Now, you've heard me talk about this iPad and holding up in front of an object and seeing the specifications and seeing the asset work in real time. And here's a great example of it. It's GE Healthcare, it's an X-ray machine, and you can actually hold the iPad up and see how many tests were done, what's the capacity left. And you can actually manage that asset really more effectively in this real time. And you can do predictive maintenance. So this tube is like at 75% capacity. Next time you look, it's at 50%. Well, let's replace that before it breaks. And that helps reduce the downtime, helps reduce waste. Because when an asset goes down, you have systems that are already moving and you'll have a waste in the system. So it really helps with that waste and that leakage minimization by doing this. So those are a couple of great examples of it. And I've seen it in real life, been over, visited the company, and seeing this happen. It's amazing when you see it in real time. The other thing I wanted to kind of point out as well, it's not just PTC in our portfolio that's kind of levered to this. So SIG, which is a leader in aseptic packaging, Tetra Pak. I don't know if I've talked too much about it before, but there's 2 players in the world, SIG and Tetra Pak, which have majority of share of that aseptic packaging. They're very focused on this. And they now have incorporated Plant 360, which is driven by digital twins, driven by the digital thread, because they want to make sure their materials are sustainable. They want to make sure they're at the forefront of developing these plant-based packaging materials. They have this new SIG signature chain, which is, you can trace it back to 100% plant-based material. So it's really all about enabling that for them. Flex, we've talked about Flex before. It's one of the largest electronic manufacturing companies globally, one of the largest contract manufacturing companies globally, and they're really embracing this Industry 4.0. it's really good to see the companies that we own, use this and seeing in real time and what it means. So they're looking at, complexity of products are increasing. They're looking at how do we do recycling, how do we do reuse more effectively, and they're actually getting up the curve in terms of the design levels. So they're not just a manufacturer anymore. They're actually coming up into the design phase to say, look, we're seeing this in our footprint. This is what we can do for your product. So it's actually quite interesting to see this in real time happen with our portfolio companies. The one I should have put in here was Assurant. So it's basically, the biggest thing for it is that reuse and recyclability. 5G phones or phones in general, they're one of the larger phone reverse logistics player in the US. They do all of T-Mobile, and now with Sprint coming on, they're a big player in Japan. They have Allegra here in Australia. You take your phone in and they will refurbish it. They do the reverse logistics around that. So it's another great example of saying, let's just not throw that phone away. Let's take it, put it through our reverse logistics platform, repurpose it. We can get whatever materials we need out of it if the phone is unworkable, or we can refurb it and sell it back. So that's reuse as well. So it's all part of that circular economy angle as well. So it's quite heartening to see our companies in the portfolio that are embracing that as well. So back onto PTC a little bit here. So, one of the things that we talk about quite a bit is connecting to tomorrow's returns today. And it's all about, in this case, it's about seeing, well, how does this business change over time? And do we think it would be more valuable as the business mix changes? So what I've done here on the left-hand side in the pie chart is split out the core business, the CAD and PLM, the growth part of the business, which is your AR, virtual reality, Onshape, Arena, and the ThingWorks, and FSG, which is your lower growth. It's more your legacy style business, which is a much smaller part of the group. So in 2018, you can see that the growth business was about 10% of the group. And the core business, CAD and PLM, was just under 74%. Now you can see this in a few years' time. So you have the growth part of the business growing at 25 to 30%, and it goes from 10% of the business to over just under a third of the business in a few years' time. The lower value FSG business halves in size, and the core business, whilst it's still growing at high single digit, low double digit, it just can't keep up with the growth of the IoT business, and it becomes around just under 60% of the group. Now, why that's important, you can look at that from a mix perspective. So you have a business that's growing 25, 30%. It was 10% of the business a few years ago, and it's going to be about a third of the business over the next couple of years. So you can see how that drives the top line growth of this business. So you have a third of the business growing at 25, 30%. Well, there's 8 to 10% growth just with that. And then you have 60% of the business growing. Let's call it 10% to make it easy. And so there's 6%. So there's your mid-teens growth, and you can actually back solve it quite easily and see a business with a strong mega trend behind it in a market that's inflecting right now, growing at mid-teens, which I think is pretty attractive from a long-term compounder point of view. The best part that I like about it is the free cash profile now. So this is all about building it once and selling it many times. They spent a lot of money in the growth engine, the IoT engine of the business, spent a lot of capital in there, and now they're going to start to benefit from that. So as a software business, you can really leverage your profile, and we expect margins to grow, another few hundred basis points over the next few years. But the big thing now, you're going to see a really strong growth in free cash for this business. They've actually guided higher than that in 24. I'm at the low end. They have estimations of could be close to 900 million of free cash. I'd rather be conservative. And if I'm conservative and the business still looks great value, I know my risk of capital loss is quite low. There are errors along the way, but I like to be conservative. And even with that, it really stacks up nicely from that perspective. So I wanted to kind of paint a picture of the circular economy, how we're positioning in it from a Delta One, which is PTC, but also other companies that are actually embracing it and using that in their profiles as well. And when they embrace it and use that, they're actually reducing their costs, they're improving efficiencies and reducing downtime, which helps with their margins and customer satisfaction as well. So it's a bit of a win-win from that perspective. Now, they always say the proof is in the pudding. They just had the results a few weeks ago. Q1 bookings is September year-end company, so they actually had their Q1 results come out. Q1 bookings were up over 30%, and that's even with still the COVID impact in there. So imagine what they'll do when they have a clean runway with this. The digital transformation that we've talked about is really being catalyzed now, with COVID-19 in terms of companies really bringing forward the digital strategies. And as the SaaS leader, they're really catching a lot of new bookings with that because companies are realizing there's so much mission critical kit here and we need to have access to it all the time. And with COVID-19, it really shone a light in terms of we need a cloud-based application, which PTC is the leader. So they had very strong annual recurring revenue growth for the business, and which was the top end of their guidance, and very strong free cash. Even though it is only the first quarter, they really upgraded their guidance for the full year pretty dramatically. So they were looking, the 5 to 8% revenue growth. It's now going to be, roughly 17 to 18% top line growth. And I think that's still pretty conservative given what we're seeing and hearing in the markets today. And from an earnings growth perspective, much stronger than expected. This first quarter, EBIT was up around 65%. So they really upgraded their full year guidance in terms of revenues and earnings growth for the year. So even with that, it still feels very good value. The share price has performed well, but with those mega trends behind it, we consider it's really just beginning for the company at the end of the day. So with that, I'll shift a bit to the positioning and performance. Like I mentioned at the beginning, no real big change in terms of the macro thoughts. So from a positioning perspective, no real big change there as well. So when we look at the mid-small cap fund, very much overweight the industrials with the Sensatas, the PTCs, and the Flex. We're overweight consumer discretionary with Tempur Sealy, with SEB in there as well. We still have the allocation to the regional banks. I must say, though, with them, given the strong run they've had, I've taken a little bit off the top, but I still see some very strong potential with them. So with that, it's more about that overweight the cyclicals, more overweight those businesses that will benefit from the growth that we'll see over the next several quarters. Still believe we are at that early stage growth profile in terms of economies. And with the Biden 1.9 trillion stimulus coming through, with more infrastructure spending coming through, I think there's still a lot more to go from an industrial aspect in terms of the growth opportunities. Biggest bogey will be inflation, to make sure that doesn't get out of hand. That'll be the biggest risk that I see. And I mentioned that commodity costs are going up, so you want to make sure you're positioned properly in that from companies that can actually pass that through. Tempur Sealy there, which is in the top 5. Like I said, we had a call with them last night, and they are putting prices through. They said the demand is so strong, there's no pushback on that. It's a company that's going to grow 15 to 20% this year from a top line revenue point of view. So very strong indications there, and feel good about that business as well. Just touching on the fund performance. In February, we're about 1.7% below where the market was, but I hope now you realize I don't run the fund based on a month or a quarter perspective. I run it on a long term, looking at these long-term mega trends and making sure we're positioned properly for that. And with that, it's one of those things that we look at, where is the fund today from a capital allocation point of view? You think about where 10-year yields have come from. Like, they were 60 bips in September when I put those regional banks on. Now we're running 1.6. So you got to make sure from an allocation point of view, you're in the right sectors, because the index itself, top line perspective, had a smart person say the index is very expensive and very minimal returns expected going forward. I think that's right. But underneath that, you're going to have a lot of changes in terms of where you need to be positioned. And that's why we made the move to the cyclicals and industrials, the financials a few months ago, so that we could participate in this. We'll keep an eye on it. No changes to date that I can call out, or major changes to date. And hopefully we can continue the performance that we put in place here. Just a quick one on the NGOV Trust as well. One thing I wanted to call out, we also have the Morphic ethical company, which is MEC. It's listed. So when we talk about the companies in the fund, when we talk about the thematics in the fund, think of it as a mirror across all these funds. The difference is that we have 2 trusts, and we have MEC, which is a listed investment company, which has over 24 cents of dividend profit reserve in place today on a $1.12 stock, trading at a substantial discount to the NAV of all these companies we have in the portfolio today. So I just wanted to call that one out. So with that, I'd like to shift to Q&A. One thing we've had, which is a bit special this time, we've had a couple great questions already put in through email. So I'll touch on that first, Lisa, if you don't mind. And then we can go to questions from the webcast itself. So the questions, there's two of them here. The first one I'll read out. Are renewable energy stocks becoming more reliable as an investment? Solar farms in Australia have had issues, e.g. falling revenue as the price of electricity comes down. So I'll address that one first. I think it's a great question. So I think from a renewable energy point of view, there's certainly a long-term global need. You have countries around the world talking about carbon commitments, being carbon neutral by X date, call it 2030 with ICE cars, internal combustion cars, shifting to electric, call it by 2040, 2050 be carbon neutral at the end of the day. And they've all made these commitments. So that's from a country level, and from a company level, they're all talking the same thing. We want to address our carbon footprint. So I do firmly believe renewables have a clear spot and clear space in your portfolio. The question is, how do you play that? And if you followed me, one thing I'd like to be is technology agnostic. I don't want to try to pick that technology or pick that project that might work. I want to pick that picks and shovels, which is going to service that industry. And if you remember a few years ago, we talked about the digital picks and shovels, and that was to enable 5G. We're still there in a big way. So that's like 3 years ago that we started that, and that's still happening today. So where I'm moving now is the renewable picks and shovels. So which companies will enable all this, because it has country support, it has corporation support, clearly from an ESG angle, from a capital allocation. Companies have to move this way as well. So it's really a strong tailwind behind it. But I don't like project-specific risk. I don't like to be at risk of a pricing change or tariff change or a credit change. So I really am try to stay away from that specific project risk point of view. But I'll own stocks like Flex. So Flex owns the largest solar tracking business globally. So if you want to make your solar field more efficient by 15 to 20%, you utilize these solar tracking businesses. There's 3 big ones in the world. Flex is the biggest with about 30% market share. So I like to own that because it provides that picks and shovels to enable these solar projects. Another one, a little bit off base, or not off base, but a little bit tangential, is Bureau Veritas. So all these assets need to be inspected, need to be tested, need to be certified. And Bureau Veritas is one of the leaders in that space. So it doesn't matter what project is out there, the more the better, because they need to be inspected. And Bureau Veritas is kind of like a second derivative way that I like to play that as well. So that's the answer around that from renewable energy. There's been a lot of new companies come through in terms of the SPACs around that, and there's a lot of risk around that as well. So there's a lot of hype around some of them. So I want to make sure I'm as agnostic as possible, and from a risk perspective, I'm investing in that in the right manner from a capital risk point of view. So that's how I like to address that. And the second one was, any thoughts on green hydrogen worldwide or in Australia? Twiggy Forrest, Fortescue is keen, and Macquarie Bank have backed it in the Pilbara. Great question. And it's interesting because I'm actually building out that thematic as we speak, building out a deck. So when you think of green hydrogen, it's such a long way. It's not an incredibly long way away, but it's right now we're more into the gray hydrogen, which is made from methane and natural gas. So it's not that pure green. That said, the EU directive, the Green Deal, they're talking about spending $430 billion by 2030 in green hydrogen. So I want to play that. So I want to find the companies that are providing that infrastructure, providing those picks and shovels to address that. And we're really going through and picking through a number of the names now to find the best way to play this. It's interesting, one company that's a big player in the fuel cells, they say we're at the first second of a 24-hour clock in this. So this is another decade-long mega trend that we can participate in on a global scale. So I'm a firm believer in it. But you think of hydrogen as more in that heavy vehicle. It's more in your buses and more in your trucks. So you got to make sure you're positioned properly for that. So we're doing a lot of work around this. And hopefully down the track we can maybe have a webinar around that and talk through what we're seeing there and the different opportunities we're picking up on. Again, a few companies that are already in there are Bureau Veritas from a inspection point of view. We had a call with them last week, and they were saying electric charging stations, they have to expand by 20x if you're going to have electric vehicles out there. There's nowhere really to charge your car outside your home. So the number of stations that are going to be built over the next decade is going to be exponential. Each one of them needs to be tested, inspected, and certified. You don't want to plug into it and get a zap. So that's like an annual recurring revenue for them as well. So they're pretty excited about that. They talked a bit about the hydrogen aspect as well, just on the back of that testing. Very early stage, but they're really starting to grow their global footprint in that as well. So that's quite a second derivative way to play that. We have Kion, which one of their biggest investors is Weichai in China, who are big players in hydrogen, and they're looking at the forklift trucks. How do we incorporate hydrogen in that as well? So they're starting to embrace that from that perspective. And also Sensata, from a sensing point of view, when you think of hydrogen, it needs all these sensors in place from a real-time data reporting point of view. Again, goes to that circular economy. So they're a second derivative play in that as well. So those are two great questions, and I hope I answered them in a way that is satisfactory. But there's a lot happening in that space right now. And with that, Lisa, I'll turn it over to you. I think you might still be on mute, Lisa.
Bill, can you hear me?
I got you now. Yep.
Apologies, we're just having some sound issues here. There's some fantastic questions coming through. The first one for you, Bill, is we've heard about a strong IPO pipeline globally. Can this fund participate in IPOs?
We can. So the short answer is yes, we can. The question is, how much do you get? So unfortunately, in terms of allocation with IPO, we get very little. Like, I'll give an example. A couple of years ago when DocuSign was coming to the market, we bid for a substantial allocation. We got like $5,000 worth. So unfortunately, from a global scale, we're going to get very little allocation to an IPO. That said, though, it doesn't mean we can't participate. So with the IPO, you get a lot of good information out. You get the S1, you get a lot of great information. So you can make your mind up with a good amount of information in terms of what you think that business could be worth. And you can participate post-listing. A great example for us in the last couple of years has been Free, which is basically the Zero of Japan. So Free was an IPO. It was coming on at 2,000 yen was the IPO price. Did a lot of work on it, had a call with the company. I felt it was worth 3,500 to 4,000 yen. Came on day one at 2,500. So when you think about that, up 25% day one, I put my full position on day one because I felt it was worth a lot more. It performed incredibly well, much better than I thought it would. And hand on heart, I sold it too early. I think it was around 7,000 yen that we exited the position. Now it's around 9,000 yen. Performed very well. But I guess the bottom line is, from an IPO allocation point of view, we're going to get very little. So take that as read, but doesn't mean we can't participate aftermarket. And we've done that a few times in the past. If you think of some of our price discovery mechanisms, post-IPO is one of the key ones in there. So an IPO could come on at a poor time in the market in terms of, timing in the market. Markets could be weak at the time, or it's not well understood, and Free was one of those ones that came on and wasn't well understood. So we can definitely participate, but unfortunately, we're not going to get those free kicks in the initial IPO.
Thanks, Bill. You've talked through Industry 4.0. What other megatrends are you observing? Is 5G still actually relevant?
Yeah, that's a good question. So 5G is actually becoming even more relevant, I got to say. I know I'm talking my own book here, but when you think about the pandemic, what did it do? So it really distributed the workforce pretty dramatically, and it put a hell of a lot of stress on networks globally. So a lot of the big telcos have been running their networks hot, but you can only do that for so long. And what we're hearing is that a lot of the 5G deployments had been slowed down because of getting access to sites So the velocity of the 5G rollout was slower this year, and a couple of our companies called that out. But they also called out the need for 5G, and the 5G deployment is actually accelerated. So I think over the next couple of years, we could see 5G accelerate from here. I think, especially when you think of the Industry 4.0, because that is enabled by 5G, and companies like John Deere, they're actually retrofitting the whole global factory footprint. They're building their own 5G local area networks to get all their devices to talk to each other and to send that to the cloud for analysis. You can't do that without that 5G footprint, and that's happening now. So I think in terms of deployment, it was slower than expected this year, but actually the need for it increased because of what's happened from a demand on network point of view. And all these new enterprise applications are now starting to come to the fore.
Thanks, Bill. Next question for you. Last webinar, you discussed your macro outlook. Is a high growth, high inflation trend still in place?
Yeah, and probably even more than I thought in terms of both. I actually didn't expect, if you remember, I didn't expect the full 1.9 trillion to get through. I was thinking more 1.5, but President Biden has spent a fair bit of political capital on getting that full 1.9 trillion through. So that's going to happen. So we're going to see some checks go through in mid-March, $1,400 per person to come through. It's going to be means tested a little bit, so that's a good thing. So that's happening. And now his next thing is infrastructure. He said in his Build Back Better initiative as part of his campaign, it's going to be the biggest domestic spend since World War II. When we think about infrastructure spending on clean energy, we touched on the electric vehicle charging stations. We didn't even talk about what needs to be spent on the hydrogen infrastructure. All this next generation infrastructure will require a lot of spend coming through. He's all about American manufacturing. He's all about American jobs. All about producing domestically more than ever. So I think from that perspective, you're going to see the growth continue to get ratcheted up. We're seeing a number of brokerage houses ratchet up their growth expectations, not just from 7% now up to 8%, some of them, with this. So I think from a growth perspective, yeah, we're seeing that come through. Inflation-wise, you know what? You can't have that growth without inflation, firstly, but even more importantly now, when we had that March, April shutdown of the world, supply chain shutdown. So foundry shut down, so semiconductor chips, it takes time to ramp them back up. So we've had the supply chain now just starting to get back into its groove. It takes time. And then a couple of weeks ago, you have the cold snap down in Texas. A lot of the chemical manufacturing was taken offline. So we're hearing a lot of stories of chemical prices going up dramatically. One example is a company called Leggett & Platt, which do chemicals for foam, that type of thing. They've put through 5 price increases through, which aggregates to over 50% price increase in chemicals for foam. And he said another one's coming. So he said, it's interesting though, he said there's been no pushback. He said all their customers saying just give us what you can because we have the demand on the other side. So you are seeing inflation come through. It takes time to feed through the system. And like I said last night with Tempur Sealy, they put a price rise through in January to offset what they had saw from commodity price increases just last year. And they're putting another one through in April because of the recent price increases that they're experiencing. So it is coming through. You will see it. The question will be, can the supply chain get back up to speed in the second half to offset that? That's what we need, or else inflation could get a little bit worse than expected. That's something I'm really watching right now, is that. So companies that I've been talking to, even with Tempur Sealy, they're seeing the inner springs that go into mattresses, they're starting to see that loosen up. Flex is starting to see a little bit more visibility of it loosening up. So we need to see that happen. I'm thinking the second half you'll start to see supply chain loosen up, but inflation's coming through the system, and it's very hard to stop it right now.
Thanks, Bill. I've got a 2-part question for you. What level of cash are you currently holding, and does the potential for a market correction keep you up at night?
So in terms of cash, I had gone into the mid-90s when we had that, bit of drawdown. If you remember a couple of weeks ago, the market got really concerned when rates really started to pick up, and we had a number of companies get sold off a bit on the back of that, and I picked some up and went into the mid-90s, which is pretty fully invested for me. Now I'm more at the lower, like in the low 90s, but I've also put on some, what it is. So as a long only fund, I can't short in the Ellerston fund, but I can buy instruments that are quasi short. And I have a firm view on this higher growth, higher inflation, which means that momentum stocks and potentially bigger cap tech stocks relatively underperform in that environment. So I've put an instrument on which is a short in terms of a NASDAQ short in that perspective. So it counts as a long, but it's actually a short. So I'm more, if you adjust for that, I'm probably in the 89 to high 89s in terms of invested capital today. Keeps me up a lot because, as I mentioned earlier, my biggest concern is if this inflation bogey comes out and people get really concerned. We saw what can happen to the markets when they get the wobbles around that, because let's face it, the world has been brought up in the last several years on low growth, low rates, high PEs in that environment. And we're going through this regime shift right now. We're getting more higher inflation, higher growth. It's a different world than a lot of people have been used to. And luckily we've been through a few of these in the past, so we can kind of, allocate capital properly around this. But it definitely is something that always keeps me up at night. And I'm taking profits where I need to, in terms of companies that have run pretty hard, and also putting on a little bit more protection than I had in the past as well.
Thanks, Bill. There's no further questions that have come through, so I might pass back to you for a final comment, and then if participants have any burning questions they want to ask, please feel free to do so.
Great, thanks, Lisa. And just final for me, like this is a little bit different, this webinar, in terms of past ones. I would love to get your feedback whether you want to see more of this type of thing, just talking a little bit more in depth of the companies we own. Because one thing I do want to do is provide transparency of every company in the portfolio. I'm proud of every single one, and more than happy to talk through each one in a little bit more detail as well. So if you like this kind of format, let us know. If not, we can revert back to the more macro, more broader discussions as well. But I think this is a good way just to let you know how we're thinking about different megatrends we're seeing out there, and a little bit more of a deep dive into some of the companies that we own and how and why we have the conviction around them. So I think that's important. Back on the question of market drawdowns, you're always worried about them, but if you have the conviction around that company and what they are, you can hold them through those negative times with the confidence that they'll come back even stronger on the other side. So that's kind of the key thing. I would like to get a little bit of feedback, if you don't mind, from that perspective.
Well, thanks, Bill. There's no further questions that have come through. So to all participants, I trust you found the session with Bill today useful. A recording will be sent through shortly, and we've also secured a date for our next Global Equity webinar, which will take place on Tuesday, the 20th of April at 10 a.m. You can register to attend through the link that's shown in the presentation and will be sent through to you, or via the News and Insights section on our website, ellerstoncapital.com. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you all again for attending, and we trust you have a good rest of your day.
Okay, thanks so much. Stay well. Bye-bye.